Hello and welcome to Core Finance. And my guest today is Connor Campbell, the financial analyst at Spreadex. Welcome to the program,
Thanks
Connor.
very much.
We're going to discuss three different stocks this morning, Reckitt and Benckiser, Travis Perkins and PayPal. So let's start with Reckitt.
Reckitt, it's up 3.4% on the year, but that is, in the grand scheme of things, it hasn't done too well since June. The first half of the year was dominated by its Mead Johnson acquisition. I think it spent $18 million on, infant formula company. I think 50% of Mead Johnson sales are in Asia, so that's a huge potential market for Reckitt. I think it has 14% of the overall baby formula market, so it was a very, very strong purchase. It also then got rid of its food division to McCormick for $4.2 billion, to get the debt down from that Mead Johnson buy. Investors were very impressed with that purchase, sent it towards £81 in mid-June, and since then it has really struggled. You had the wider retail sector concerns in June that dragged a lot of retail stocks lower, as we'll see with Travis Perkins in a sec. And then in July, Reckitt posted a truly horrible half-year report. I think it said it had to cut its full-year revenue target growth from 3% to 2% based on the impact of the NotPetya cyber attack earlier in the year. I think it also said that would cost around $100 million in terms of revenue because it affected deliveries and production and things like that. On top of that, it said it had to put aside £318 million for a potential investigation into Indivior, I think is how you say it, which was the pharmaceutical company Reckitt spun off back in 2014. That's been investigated by the US companies due to I think it was that Reckitt had prevented generic drugs from making it to the market. And it also warned that £318 it could be materially higher by the end, so that's a huge thing. And the sort of the bitter cherry on top was that it posted a 1% drop in like-for-like sales. So it was a really, really awful July half-year update. You can sort of see in July it saw that huge plunge. Since then, it hasn't really been able to find anything to stem its losses. In mid-September, its majority shareholder JAB Holdings cut its stake from I think 8.9% to 7.9%, which obviously wasn't a particularly great vote of confidence in the stock. In October, it's bounced a bit back towards the £71 mark. But our clients, they're not. I think that's where they see that bounce ending. They're sort of selling around that £71 mark. I think
dead cat bounce.
Just because of how much bad news Reckitt has unleashed recently. I think if it can avoid posting any more nasty surprises this week, I think it reports on Wednesday. If it can avoid any more nasty surprises with its Q3 figures and can maybe post a reversal of those like-for-like losses and can see maybe a bounce in like-for-like sales, then it could grow, but with things like that US investigation hanging over its head now, and it's in a difficult sector, going forwards, I think, those are the reasons why our clients are selling around the £71, £72 mark.
Yeah, certainly it looks it looks like it's got to break above the £72 mark before anyone's going to feel that things have turned around.
Yeah.
And now we've got Travis.
Travis Perkins, again, sort of similar chart really to Reckitt. Strong start to the year, hitting highs of like £17 in June. Miserable June for the retail sector as a whole. Back then you had, inflation, real wages falling, sort of fears of an economic slowdown, etc., etc. Sort of well-known factors there. And then, it's fallen. It manages to bounce away from that £14 mark. It did that in the first half of the year as well. Its figures, meanwhile, full year figures in March, 2.7% rise in like-for-like sales was sort of overshadowed by 67% fall in pre-tax profit. Then first quarter figures in April, again 2.7% rise in like-for-like sales, and that was despite a 2.6% rise in prices, which is it's pretty healthy growth. Half years in August, total revenue was up 3.5% to 3.2 billion. That's decent, but then pre-tax profits fell 4.5%. And the CEO wasn't particularly positive. I think he said that, DIY competes with things like new sofas, new cars, going on holiday, other choices like that. And in the current economic climate, with consumer confidence low, fears about the economy, and people are going to likely opt for a holiday rather than an extension, things like that. Which that's a fair enough point. However, again, still in the half year, maintained a 2.7% rise in like-for-like sales. That's for the last few quarters now. It's been hitting that 2.7% rise, and I think from our client's perspective, if it can hit that 2.7% like-for-like sales, obviously ideally higher, but if it can hit around that that same level on Thursday, then there's no reason why it can't rise from that £14.50 mark. Our clients, they've been quite heavily buying around that £14.50 mark. I think it's held out just above that £14 mark for a while now. There is room for it to grow. It's like-for-like sales have been so consistent that it's, you know, consistency in this current retail climate is the equivalent to sort of explosive growth, I guess, and I think that's what our clients are basing their trading on.
So a defensive play, indeed. And finally, we have PayPal.
PayPal, yeah, I don't think you couldn't really get a sweeter looking chart than this, really. It's had a phenomenal year. It had a bit of a wobble in January, but since then it's just on the up and up.
I can't imagine many of your clients have been shorting that.
No.
Or not happily.
PayPal have been sort of fairly aggressive in their expansion plans this year. Back in May, they rolled out integration with Google's Android Pay. Then in June, it was announced that people on iPhones and iPads, people using the App Store could now use PayPal to pay for purchases, which is a pretty big deal because Apple doesn't tend to go with third-party operators and stuff like that. So that was a huge deal. Then also in June, it extended its deal with Visa. I think formerly it had a deal with Visa that covered the US and Asia in terms of producing a sort of co-labeled bank cards and other financial services and things like that. And that deal extended into Europe. So really moving quite aggressively ahead with their expansion with Visa. Second quarter figures in July, both earnings per share and revenue beat on estimates, 46 cents and 3.14 billion respectively. And Venmo, which is its mobile payments subsidiary, that saw total payment volumes increase 103% in the quarter, which is huge. And then again, it announced further expansion plans. It announced a partnership with Baidu in China, which is massive. That takes it into, I think it's the biggest mobile payments market in the world, China, and getting a foothold there with an incredibly successful company already in that region is huge, and you can see why investors have been so ready to get on board with PayPal this year. In terms of its third quarter figures on Thursday, analysts are expecting a 25% jump in earnings to 44 cents per share, and then a 19% increase in revenue to 3.17 billion. So really huge figures there. I think investors are also going to want to look for updates on those various, Android Pay, the App Store, and Baidu deals, and I guess further sort of explosive growth from Venmo. Venmo has set that target of 100% growth now, so I think investors are going to want to see that again. Our clients buying around the $67, $68 mark. Obviously, with a stock like this, there is the risk that it's climbed incredibly rapidly this year, and these quarterly reports will operate on a knife edge of expectation that the slightest miss can cause a sort of a disproportionate drag downwards. But like I said, our clients buying around the $67 mark. I think even if it does dip on Thursday, it's really got its eye on the prize in terms of expansion, and going forward to the rest of the year, I think even if it does dip, there is still room for growth for it heading into 2018. Yeah,
I can see that you've got a small trading gap here on the chart, but that could be filled almost instantly. It's tough to back that trend. Thank you very much.
Thanks
indeed.
very much.